Welcome to the Deep Dive. Today we're tackling three words you probably hear all the time: price, value, and worth. They often get jumbled together, but they're actually really distinct. And understanding the differences, well, it's pretty crucial for making smart decisions, whether that's in business, investing, or honestly, even just everyday life. Our mission today, to help you get a real handle on these concepts, see why they matter, and figure out how to use each lens. We'll start with the obvious stuff, then get into the calculations, and finally touch on the fuzzier side of things.
Exactly. And we've got a bit of a roadmap for you. First up is price. That's simple enough. It's the number on the ticket, right? What you see. Then we'll dig into value. That's more about calculation, what something's fundamentally worth based on its ability to generate cash or utility. And last, we'll explore worth. This one's a bit broader. Think strategic fit, maybe even emotional connection. And along the way, we'll sprinkle in some practical insights so you can really apply this stuff.
Okay, sounds good. Let's unpack this, diving right in. So, first up, price. This is the one we all see every day. It's basically just what you pay for something right here, right now. It's objective. You can look it up. The price on a pair of headphones or the latest stock flashing on the screen, it's the market's immediate verdict.
Right. And the thing about price is it's constantly moving. It's driven purely by supply and demand at that specific moment. It gets pushed around by loads of things, liquidity, for example. Like, how easy is it to actually buy or sell? Market sentiment plays a huge role too, fear and greed. Even transaction costs factor in.
Yeah.
And because of all that, price can be, super volatile. It bounces around based on news, rumors, sometimes just noise.
Yeah, that volatility is key. Let's make it concrete. Think about those headphones again, say they're listed at $600. That price tag reflects a bunch of things. Manufacturing costs, sure, but also the retailer's markup, where it sits compared to competitors. Then, boom, a flash sale hits. Price drops maybe even below cost for a short time. That's price reacting instantly. Or think about a stock trading at, say, $12.50 a share. That price wiggles all day long. Buying pressure, selling pressure, a news headline, some macro data comes out. It's totally normal to see it swing 2-3% in a day, even if the actual company behind the stock hasn't fundamentally changed at all. So maybe take a second. You listening, think about something you own or follow. A house, a stock, maybe even a collectible. What's its current market price?
And it's really important to remember, focusing only on that price can trip you up. Big time. If you just react to the market swings, you can easily buy high and sell low. Bad timing. Liquidity, or lack of it, can also mess with things. The price you see might not be the price you actually get when you try to trade, especially with larger amounts. And probably the biggest trap. Just because something has a low price doesn't mean it's cheap or a good deal. The underlying asset could be genuinely weak. I actually spend time watching order books, seeing where buyers and sellers are lining up. That shows you the price dance in real time. But it's just the dance, like you said earlier. It's not the whole story.
Right, the dance, not the music. Yeah. Love that.
So, okay, if price is just the surface level, the observable bit, we need to go deeper, right? For anyone making serious decisions, you can't just rely on the ticker. And this, I think, is where it gets really interesting. We move from just observing to analyzing. We move to value. Value is about what an asset is fundamentally worth. What's its capacity to actually generate benefits down the road? We're talking cash flows, earnings, utility. And the key difference here, value isn't just something you see. It's something you calculate.
That's the core distinction, yeah. Now, estimating value, it definitely involves some judgment, some subjectivity, but it's grounded in pretty rigorous analysis. In finance, we generally lean on a few main methods. The big one is discounted cash flow analysis, or DCF. That's probably the most fundamental. We also use comparable multiples, looking at similar assets or companies, but adjusting for key differences. And sometimes, especially for physical assets, you might look at replacement cost. But with DCF, the basic idea is you forecast the future cash flows you expect an asset to generate. Then you figure out what those future dollars are worth today, using something called a discount rate, often the WACC, or weighted average cost of capital. You also need to estimate a terminal value. What's it worth beyond your detailed forecast? Essentially, you're building your own informed estimate, separate from the market's daily mood swings.
Okay, let's try to picture that. Say you're analyzing a business. You forecast maybe $10 million in free cash flow next year, and you think it'll grow, say, 5% a year for the next 5 years. Then you need that discount rate, the WACC. Let's pick 10%. That reflects the riskiness of those cash flows. And if you assume after 5 years it grows steadily at 3%, forever that's your terminal growth rate. So you take each of those future cash flows, discount them back to today using that 10% rate, add up the present values plus the present value of that terminal value. And that number you get, That's your estimate of intrinsic value. It becomes your compass, right? Guiding your decisions away from just the price noise.
Precisely. It's your analytical anchor. And look, for quicker checks, people definitely use multiples like EV/EBITDA or PE. They're useful for comparing similar companies fast. But, and this is a big but, you have to adjust those multiples. You can't just take the average. If your company is growing faster or has better margins or is less risky than its peers, it deserves a higher multiple. So maybe the average peer trades at 8 times EV/EBITDA, but you might argue your target deserves 10 times because of its stronger prospects. You need to justify that adjustment. But be careful. There are traps here, value traps. It's easy to be way too optimistic about growth, which just inflates your value estimate. Or maybe you ignore how the company's debt levels might change, which messes up your discount rate. And a huge one, not doing sensitivity analysis. You need to see how your value changes if your key assumptions are wrong. My advice, always run different scenarios. Best case, base case, worst case. If the value number jumps around wildly, depending on the scenario, you need to question your assumptions, maybe dig for better data.
Those value traps sound dangerous. What's a common mistake you see people make, even if they are running scenarios, something that still leads them into a trap?
A really common one is relying too much on past performance. Just assuming the future will look exactly like the last few years. People often just extrapolate trends without really asking the tough questions. Is this growth sustainable? What could disrupt this? Is the market changing? You absolutely need that critical thinking. So yeah, value connects today's reality with tomorrow's potential. It's your analytical North Star, but you've got to use it with discipline.
Okay. That clarifies the value piece nicely. And actually, before we move on to worth, we've got a couple of great listener questions that bridge this price and value discussion.
All right, let's hear it.
First one is, can value ever exceed price for extended periods?
Oh, absolutely. That's basically the whole premise of value investing. You find companies where your calculated intrinsic value is significantly higher than the current market price, and you wait. Sometimes the market takes months, even years, to catch up and recognize that underlying value. Think of value stocks sometimes outperforming growth over long stretches. It takes patience and conviction in your analysis, trusting your numbers over the market noise.
Makes sense. Okay, second question. How do I pick the right discount rate if my cash flows are unpredictable?
Yeah, that's a tough one, but crucial. If cash flows are really uncertain, your standard WACC might not capture that extra risk. So one approach is to add a specific risk premium on top of the WACC for that particular project or investment. The higher the uncertainty, the bigger the premium. Another way is to use different discount rates for different scenarios. Maybe use a higher rate for your worst-case cash flow forecast to reflect the higher risk in that outcome. It's all about building an attrition, a margin of safety, for what you don't know.
Got it. Build in that margin of safety. Okay, great questions. So with price and value covered, let's move to that third concept, maybe the most nuanced one, worth.
Right, worth. If value is the calculation, worth is. Well, it's kind of the glue between the price and the value. It captures all those other factors, often intangible ones, that influence a decision but aren't purely in the financial model. Think about things like brand reputation, or maybe how well a company's mission aligns with your own goals or values. Strategic fit is a huge one in business, and sometimes, plain old emotional attachment plays a role.
So it's less about a precise number and more about significance.
Exactly. It's less precise, definitely harder to quantify sometimes, but it can be incredibly powerful in driving major decisions. Key dimensions here are things like strategic synergies. What happens when you combine two things? Do you get cost savings? New market access? That's worth. Brand equity, customer loyalty, that deep connection a company might have. That's often worth more than the assets on the balance sheet. And don't underestimate emotional factors, especially with founders or long-term stakeholders. Their sense of legacy or attachment can heavily influence their perception of worth.
Let's take an example, strategic worth. In an acquisition, right? A company often pays more than the target's calculated standalone value. That extra amount, that premium, that's often paid for the worth of the combination. Maybe they figure, okay, we can save $5 million a year in costs by merging operations. And maybe we can cross-sell our products to their customers and generate another $3 million in revenue. So those synergies, totaling $8 million, could justify paying that much above the target's calculated intrinsic value. That's the strategic worth kicking in.
Precisely. And then there's the flip side you mentioned, emotional worth. We see this all the time, especially with private businesses. Founders might feel their company is worth, say, $20 million because of all the blood, sweat, and tears, the family legacy. But a buyer runs the numbers, looks at the cash flows, the market comps, and says, my analysis puts the value at $12 million. That gap isn't necessarily about the financials. It's often that emotional worth clashing with the calculated value. It can absolutely kill deals if not managed carefully. And it's not just M&A. Think about sustainable brands. People might pay a higher price for a product. The strict financial value calculation might not fully explain that premium. Part of it is the worth consumers place on the brand's ethics, its mission, its alignment with their own values. That perceived worth drives their willingness to pay more, even if a cheaper alternative exists.
That's a really good point. It taps into something beyond just the utility of the product. But if worth is so subjective, so tied to strategy or emotion, how do leaders actually use it without just, throwing the financial analysis out the window? How do you make it a concrete part of the decision, not just a vague feeling?
Yeah, that's the challenge. And the art. Good leaders try to translate strategic goals into some kind of measurable worth framework, even if it's not purely financial. Maybe use a scoring system. Let's say entering a new market is a top strategic priority for your company's future. The immediate financial return of an acquisition target in that market might look okay, but not amazing based purely on value. But the worth of gaining that strategic foothold, accelerating your entry into that crucial market, that might be immense. I actually worked with a client who did this. They built what they called a fit-for-purpose scoring model. Every potential acquisition was rated not just on financial value, but also on strategic fit, cultural alignment, integration ease, these worth factors. And this wasn't just academic. It helped them justify paying I think it was about a 20% premium for a target that was a perfect strategic fit and accelerated their key goals significantly. The pure value calculation might have said walk away, but the strategic worth sealed the deal, and it turned out to be a great move for them. So it needs structure, but it's powerful.
Okay, that model makes sense, translating strategy into scores. So we've got price, what you see, value, what you calculate, and worth, what you derive strategically or emotionally. What does this mean for you, the listener, trying to make a decision? Let's try a quick scenario workshop. Imagine you're evaluating a company, let's call it EcoMarket, an online grocery platform. You need to decide, invest, acquire, or pass.
Okay, let's walk through the three lenses.
Part 1, price check. First, you look up the current situation. What's EcoMarket's stock price if it's public? Or what's the seller asking if it's private? You'd also look at comparable companies. What are other online grocery or e-commerce firms trading at? Maybe the average EV/EBITDA multiple is, say, 15x. That's your market context, your price benchmark.
Right. Step 1, know the current market price or asking price. Part 2, value estimation. Now you do your homework. You build that quick DCF in your head or on a spreadsheet. Forecast EcoMarket's free cash flows for maybe 5 years. Choose a discount rate, maybe 12%, feels right given the risks in online grocery. Assume a terminal growth rate, say 2%. You run the numbers, discount everything back. What intrinsic value per share do you calculate? How does that compare to the price from part 1? Is it higher? Lower?
Okay, so you've got the market price and your calculated value. Now for part 3. Worth assessment. This is where you think bigger picture, especially if you're considering acquiring it. What are the potential synergies? Could you merge their logistics with yours? Cross-sell your products to their customers? Would owning EcoMarket help you expand geographically faster? List those out. Then assess the strategic fit. How well does EcoMarket align with your company's mission and brand? Score that alignment. And don't forget the softer stuff. Is their leadership team impressive? Do they have a strong company culture? What about their social impact? Does that resonate with your stakeholders or customers? Factor that worth in.
Exactly. Now you pull it all together. You have the price, you have your calculated value, and you have your assessment of the worth. Synergies, strategic fit, intangibles. The simple decision rule, conceptually at least, is if the price you have to pay is less than the sum of the value plus the worth that you specifically derive, then it might be a green light. If price value plus worth, then you probably need to reconsider, negotiate harder, or walk away. It forces you to be explicit about why you might pay more than just the calculated value.
That's a great framework. Price, value, plus worth. It forces a holistic view. So wrapping up today's deep dive, we journeyed from price, the number you see, to value, the number you calculate, all the way to worth, the significance you derive. Remember the key distinctions. Price is objective now, but it's fleeting. Value is analytical, it looks forward, requires real thought. And worth. That blends the strategy, the emotion, the intangibles that often make the biggest difference.
That's it. And the practical takeaway for you is try to use all three lenses. Don't get fixated on just one. Check the price, definitely, but validate it with your own value analysis. And then make the final call considering the strategic and maybe even emotional worth involved. It leads to much more robust decisions, I think.
Absolutely. And maybe a final thought to leave you with. In today's world, with information overload and constant market chatter, how much of price is becoming just noise? And are we getting any better at actually measuring the worth of things like sustainability or social impact? Actually, that ties into our next deep dive. We'll be exploring how ESG factors, environmental, social governance, are increasingly shaping company value. You definitely won't want to miss that one. If you found today helpful, we'd love it if you could rate or review the show. And hey, if you ran through the Eco Market workshop in your head, share your thoughts. Use hashtag DeepDiveWorth on social media. Thanks for joining us.